So in this video, I'm going to be talking to you about what is Dan Pena's 60-40 model. You may have heard about this from Dan Pena if you have been watching his content, if you have been following him. There is a deal structure that he proposes, which is known as 60-40 model. And when I say deal structure, what do I mean by that? So the whole Dan Pena's QLA model is based on buying companies. So when you buy a company, you're buying the ownership of the company. Um, and I'll get to that in a second. But if you don't know who I am, my name is Prithvi Chauhan. I'm an entrepreneur, and I have done two of the Dan Pena seminar, and I think he has only two: the QLA seminar and the QLA hardcore. And both these seminars, when I did them, they costed £20,000 each. And you can't do the QLA hardcore seminar unless you've done the QLA seminar. So I've done both of them, and I've had the opportunity to implement it in Dubai. And I have been in various multi-million dollar negotiations. I've built brought some pretty powerful people together to be part of my team, including a CEO of a $3.5 billion company, some of the top lawyers in the UAE who advised on a $13 billion bank merger. There's one lawyer who did that, who was my business partner. And I've talked to all the major banks in the UAE, including Citibank, HSBC Bank, and the regional banks that have assets of billions of dollars. I've talked to these bankers who finance 1 million, 5 million, 10 million, 20 million, and even $100 million deals. And I've met and talked to over several hundred healthcare businesses. So I have had exposure um, into the system. It's not just about doing the seminar; it's also about implementing and practicing. In addition, I've obviously talked to and met a lot of people who have been to the seminar, who acquired companies, and how they did it and how they structured the deals. So that's where I come from, just giving a background. So let's get back to the topic where we started. So when Dan Pena says a deal, he means acquiring a company. And when you acquire a company, you're acquiring an ownership stake in the company. So, you could acquire 100% ownership, you could acquire 50%, 60%, 30%, um, etc. So there is a percentage of ownership that you acquire in a company. And we acquire profitable companies that have a good track record, good profit margin. So that's the criteria. But let me get to the 60-40. What is it? So so there are two aspects of the company that we need to understand. One is the ownership, which is also known as shares. That's one thing. And the second thing is the cash flow. And these two are connected, but they are independent in some sense. You could own 60% of the company, but you may not have 60% of the cash flow. If that is subject to the type of agreement that you may have with the seller, or the seller can own 40% of the company and he may not have the 40% profit because the ownership and the profit is different. And whether a company pays dividends or not, that's subject to discussion, and it's something that you can agree on. So what is the 60-40 model? 60-40 model is as follows. You acquire 60% of the company. Okay, you acquire 60% of the ownership of the company, um, and the owner has 40% of the company. But when you ha- um, when you are paying off the debt, and you raise capital from the banks to acquire the company. Okay, so the 60% ownership is acquired through bank financing. It's not your money, it's the bank's money. Well, when the bank gives you the money, they expect to get paid, right? So you raise capital from the bank and you paid off the seller, but you did not pay him 100% for the 100% of the company. You only paid him for the 60% of the company. And but you have an agreement with the seller that 100% of the cash flow is going to be used to pay off the debt. So even though you own 60%, the company's 100% of the cash flow is going to be paid, used to be paid the bank. Now, why would the owner agree to this? Well, there are a couple of reasons. First of all, the debt is not in your name. Yes, you raised the money. Yes, you went to the bank and got the financing, but the financing is in the books of the company. So the debt that you raised, let's say it's $1 million company, and you are paying $600,000. Well, you raise the money from the bank, but the obligation to pay this money is not on you personally. Let's say your name is John. It's not on John. It's on the company, that because the company is the borrower. And so that's an important distinction. So if the company is the borrower, then the company has debt. If the company cannot pay off the debt, then the company will have to be listed for bankruptcy. So what happens to the 40% ownership and 60% ownership that you have in the company? It's going to be worth nothing. So it's in the interest of the company, both in your interest and it's in the interest of the owner, to pay off this loan first, instead of paying yourself, because then you're robbing the company when it has financial obligations to financial institution. So you have to agree with the seller that, listen, bank is first in the line. We can't pay ourselves profit when the company has debt obligations. And then you have to explain that to the owner. He may not understand. And then you have the 60/40 model. So that's what you do. To summarize, you acquire 60% of the company, raising capital from a bank. And the moment you raise that capital, there is debt liability in the books of the company. You own 60% of that company, and the owner owns 40% of that company. However, 100% of the cash flow goes to pay off the debt. Now, that's the structure. And I'm oversimplifying here. You need a board to validate it. You need a corporate finance expert. You need an accounting expert, lawyer, and they have to validate the structure, to make sure you're in compliance and you're doing it correctly. But I'm just sharing this for your understanding. Just that little caveat disclaimer here. So that's the structure. 60% your ownership, 40% owner, 100% cash flow goes to pay off the debt. Um, let's run a scenario and it'll become even more clear. So let's say the company has profits of $250,000. Okay, let's just assume the company is doing $1 million in revenue and $250,000 in cash flow. Okay, 25% margin, not bad. And you are valuing the company at 4 times cash flow. Okay, so whatever the yearly cash flow is, you're multiplying it by 4, and that's the value of the whole company. So our cash flow was $250,000. Okay, you multiply that by 4, you get 1 million. So what's the value of the company? 1 million. Okay, but you're not paying 100% to the seller 1 million. You're going to pay 60% of that, let's assume. So that is going to be $600,000. So the total value of the company is 1 million, and to acquire 60% of the company, you are paying $600,000. Okay, that's the deal. And 100% of the cash flow is going to be used to pay off the loan. So $250,000 is going to be used to pay off a total debt of $600,000. Now, if you have to pay this money back in 1 year, the deal is not going to work out, because the yearly cash flow is 250 and the total debt is 600. So what you do is you take the debt and you spread it on, for over 5 years. So when you spread it over 5 years, then, the number is going to be about, um, you know, 1.25 or 1.5. I don't know exactly. I don't have the calculator with me, but you can do the math. $600,000 divided by 5. And I think the number is going to be 1.25 and 1.5. So that's your debt payment. Okay. And what's the yearly cash flow? $250,000. That's our yearly cash flow. So you see, $250,000 of cash flow pays for 1.25, 125,000 or $150,000. And you can see how, the full cash flow covers the debt service by a big margin, and that's the basis for financing. So what's the benefit of doing 60/40? Why not pay the full amount and acquire the 100% of the company? Won't that be better? Well, first of all, you're acquiring a company you know nothing about. Even if you have two healthcare CEOs that are completely experts in managing healthcare companies, still it's a company that you don't understand. You didn't create this company. The owner did, the founder did. You may understand whatever about the industry and the operations, you may be a genius, but the employees don't know you, the customers don't know you, you don't know where the controls are, and you don't know what the owner is hiding from you. Okay. So there are many variables that you don't understand. You are an outsider and the owner is on the inside. So if you acquire 100% of the company, the owner can sell you the license and then open a shop next door in some other nearby area. And essentially he sold you an empty license, and then he messages his clients that, hey, I've changed my name and I've changed the place, and essentially we are, and he takes away all the employees. So what did you buy? Nothing. You bought an empty license. So it's important to avoid that scenario and to make sure that you don't acquire 100% of the company. You want to make sure that the owner is locked in for the 40%, because if he has a continued interest and if he's supposed to receive some funds from you, then you can keep him accountable. And you can also offer him, so when do you acquire 100%? You acquire in phases. Phase one is 60%. And then he has to run the company properly. Okay. And then he pays, the company pays off the debt. I think in 3 years, $250,000 is yearly cash flow multiplied by three. I think that's $750,000. You can easily pay off the debt in 3 years or 2.5 years. Okay. So during that 2.5, now you have to pay in 5 years, but you can pay early, and you have to make sure that the owner continues the business, and you can pay off the debt in 2.5 years. So you can agree with the owner that, listen, we are gonna once we pay off the banks, we can agree on a date where we can buy you out for the remaining 40%. And you can agree on a price up front, what that price would be. And if the company goes down, you pay less. If the company goes up, you pay a little more. So that's a basic example of 60/40. Another example is that you're going to do this over many companies, over several companies. You may do this with 10 or 20 companies. So you may acquire 10 or 20 companies and you may have this structure. And after you combine them together, you're going to be selling this at a much higher price. So you can tell the seller that, listen, if you stick with us till the end, after 5 or 7 years, we will be selling the whole portfolio. At that time, you can leverage this 40% interest at a much higher valuation if you just keep this interest in the company instead of selling it to us. So the reason you do this is because you want his interest aligned with your interest. That's it. If your interests are aligned, you're less likely, to go to cheat each other, and mainly him cheating you. So you have to make sure you structure the deal in a way that you get on the same boat. You're not on separate boats, you're in the same boat. Whatever happens to the boat happens to both of you. So when you have that dynamic, then you have an automatic check and balance, and you can reduce a lot of risk. The banks love the fact that the founder who created the company over the last 15, 20 years is still going to be continuing, and the current management team is going to be continuing, and you're holding back cash. So that's an advantage. The risk, you're protecting the risk. Another thing is you could raise $1 million to close a deal, or you could raise 600,000. And $1 million of financing can be financed with $250,000 cash flow, or you can finance the $250,000. You can finance a $600,000 loan with 250,000. So obviously, the cash flow, if you acquire 60% or 100%, stays the same, which will finance the debt. But your debt, instead of 1 million, becomes 600,000. So the cash flow to debt service coverage is much higher. You have a much safer margin. You're going to have double the amount of cash flow in relation to the debt service per year. So we calculated, in the $600,000 scenario, you're going to have probably 125 to $150,000 a year. And in the $1 million scenario, you may have, million divided by 5 is going to be $200,000. So $200,000 payment is covered by 250, or $125,000 payment covered by 250. So obviously, 600,000, paying 600,000 is better than paying 1 million. That's as simple as that. And in both scenarios, cash flow remains the same. So this is what 60/40 is. There are many reasons for it. One, when you have lower debt, you have lower risk and higher cash flow. You have the owner's interest continued, which is an important component, because the owner created the business and he's on the inside. It's important for you to have his interest aligned with your interest, so you are on the same boat. And so it's a protection, and it's an alliance, and you're reducing the debt, and you're increasing the debt service to cash flow ratio, which means that the bank is going to look at the deal favorably. So that's the 60/40 rule. I hope I was able to make it palatable, or I hope I was able to explain that well, because these things, with numbers, can get a little bit confusing to share it. Instead of writing it on a piece of paper, to share it in a verbal language. When you see the numbers, it's very clear. So if you felt a little bit confusing, this, that, don't blame yourself for it. If I write it down, you will understand it. And if you write it down, you will understand it very well. So if you didn't understand it, play the video again and write it down, and you will be able to see it. But the main thing is, whether you acquire 100% of the company or 60%, you can have access to the entire cash flow to pay off the bank, not to put it in your pocket, but to pay off the bank. So the financing could be $1 million or 600,000. The cash flow remains 250. And that's the distinction. And you can spread the financing over a long period of time, which makes the payment smaller in relation to the cash flow. And that's why we do the 60/40 model. I hope that clarifies, and I'll talk to you soon.